All right, let's talk about some of the most common and, most costly mistakes that trip up pretty much every new investor. But more importantly, we're going to look at how you can sidestep them completely. So let's just dive right in. So, picture this. You've done it. You put your hard-earned money into a stock. You're feeling good, maybe a little excited. But then the price drops, and then it drops again. And all of a sudden, you're just frozen. What do? Do you sell and just take the loss? Do you double down and buy more? Or do you just close your eyes and hope it all goes away?
If that feeling sounds at all familiar, trust me, you are not alone. That moment of pure panic, that's what we call the amateur's dilemma. It's that awful feeling of having zero control, where all you can really do is cross your fingers. But as we're about to find out, hope is not an investment strategy.
And that feeling leads us directly to the first and maybe the most fundamental mistake. It's not about picking the wrong company. It's about chasing the wrong goal from the very beginning. A lot of new investors don't even realize they're playing the wrong game right from the start. Let's break this down. There are really two different games you can play. On one hand, you've got chasing capital gains. The goal is simple, right? Buy low, sell high. But the method? Well, it relies on timing the market perfectly, which is basically just a mix of hope and luck. On the other hand, you can focus on cash flow. Here, the goal is to get a steady income from the stuff you own. And that, right there, is the huge difference between speculating and actually investing for the long haul.
I mean, think about it. When your entire strategy depends on a price just going up, you're not really investing in the business itself. You're just betting on what other people might pay for it later. Or as Robert Kiyosaki put it, in most cases, investing for capital gains is just straight-up gambling or speculation.
Okay, so that brings us to the second huge mistake, just completely misunderstanding what risk actually is. This usually happens when we just blindly follow that generic, one-size-fits-all advice you hear everywhere, without ever stopping to think about what risk truly means.
We've all been told a million times to diversify, to be safe. But Warren Buffett once said something that kind of flips that whole idea on its head. He said diversification is basically protection against ignorance. It's a strategy for playing not to lose, which is a very different thing from playing to win.
And this changes how we should think about risk. See, the real financial risk isn't the stock or the bond or the market itself. The real risk comes from your own lack of financial education and your lack of control. To put it simply, when you don't really know what you're doing, pretty much everything is risky.
And just think about what diversification doesn't save you from. When the whole market takes a nosedive, that's systemic risk. Like back in 2008, it can drag everything down with it. And what about inflation, purchasing risk, which is quietly making your money worth less and less every single day? Or when a new law gets passed, legislative risk, that can change the entire game overnight. See, diversification isn't the magic shield people think it is.
Okay, enough about the problems, right? Let's talk about the solution. And it all boils down to making a shift from that amateur mindset to using a professional's playbook and actually taking back control. And the difference in that mindset is just huge. The amateur hopes, they follow the crowd, and they're always playing defense, just reacting to whatever the market does. But the professional, they have a system, they actively manage their risk, they concentrate their knowledge so they can win, and they only focus on the things they can actually control. It's a completely different world. So here's the secret. You do not need a crystal ball. Investing is not about telling the future. It's a lot more like forecasting the weather. You look at the data, you spot the patterns, and you build a plan based on what's most likely to happen, not what you wish would happen. And here is a really simple, actionable system to put that idea into practice. Before you even think about putting $1 into anything, you TST your trade. First, T for time. How long are you planning to hold it? E for entry. What's the exact price you'll buy at? S is for stop. Where will you cut your losses if you're wrong? And T for target. At what price will you take your profits? If you have this plan, you will never be in that paralyzed amateur's dilemma again because you've already decided what to do, no matter what happens.
So where do you begin? What's the absolute most important first step you can take on this journey from amateur to pro? Well, I can tell you it's not picking a stock or a mutual fund. It all comes back to this one central idea. And of course, Buffett said it perfectly. Risk comes from not knowing what you're doing. If the biggest risk out there is just plain ignorance, then the best way to lower that risk is to get smarter.
So before you go investing your money in stocks or bonds or anything else, you have to first invest in your single greatest asset, your own mind.
A real financial education is the bedrock for everything else. It's the one investment that truly has a guaranteed return.
So, I'll leave you with one final question to really chew on. Think about your own approach. Are you just trying to avoid losing, playing it safe and following the generic advice? Or are you willing to do the work, to get educated, and to learn how to invest to actually win? The choice, as they say, is yours.